In recent times, the stock market has been the subject to a lot of shifts and fluctuations. Now, that's due to a lot of things, one of them being the COVID-19 pandemic. That's left a massive disparity in the financial world, and then as a result of that, the whole world has shifted online. And, well, whenever the internet is involved, something interesting is bound to happen.
It means that we're not going to the game.
And, well, let's take a look at the very popular rumors that's been circulating around the stock block, AMC and GameStop. Price prediction and short game of squeeze. Is it happening? Let's dive in. Let's start off with some context. So what happened was that the shares of GameStop and AMC Entertainment surged 52% and 21% respectively, helping them recover a significant portion of the recent losses that they'd sustained. Yep, GameStop's stock shed a third of its value after the video game retailer's fourth quarter revenue and operating profits fell short of Wall Street's expectations. Analysts were also peeved at the fact that GameStop failed to offer much insight into its digital transformation plan and declines to take questions during its earnings call. And to nobody's surprise, AMC Entertainment likewise went down too, following news that Walt Disney would make two of its upcoming movies available on its popular Disney Plus streaming service the same day they begin showing in theaters. And the digital transition has been nothing short of a bitter death for the cinema business. Some investors apparently felt the sell-off was overdone. Analyst Stephanie Wissink boosted her share price forecast more than tenfold, from $15 to $175. Wissink posited that GameStop would successfully transition its business away from its brick-and-mortar stores to a primarily e-commerce model, while also seizing opportunities in esports and collectibles. It should be noted, however, that GameStop hired Jefferies to assist with a potential share offering. Jefferies also owns a significant portion of GameStop stock. Still, investors bid up GameStop's shares to $183.75, or within about 5% of Jefferies' new price target. Seeing GameStop rally likely also helped to boost the sentiment for AMC among traders on Reddit and other social media sites. Many individual investors have tried to coordinate their stock purchases on these sites in recent months, which has helped to fuel violent price swings in GameStop, AMC, and other so-called meme stocks. Companies that have had their shares hyped on the internet, both to the upside and downside. By bidding up their stocks so sharply, investors are betting that GameStop and AMC will not just survive, but thrive in a post-pandemic world. Yet, GameStop's stores still face an existential threat from video game downloads, while rapidly growing streaming services like Disney Plus threaten the long-term survival of AMC theaters. Thus, despite today's rally, both GameStop and AMC remain high-risk investments. And yeah, this may seem sort of surreal because the meme stocks were back in business. Think about it. Both of them are businesses that are nearly obsolete. GameStop is a video game retailer that specializes in offering customers the ability to buy and sell used games. In comparison, AMC is in the business of bringing people together in one of its over 1,000 movie theaters to watch box office attractions on a big screen with the latest technology. But their stock prices are experiencing similar volatility. Most famously, GameStop and AMC are a part of a buying frenzy induced by a discussion on a Reddit forum called r/Wall Street Bets. The group has been targeting stocks that have a high percentage of their stock sold short. Short selling allows you to profit if the price of the stock goes down, and the Reddit group's aim is to perform a short squeeze. This creates a heavy buying momentum to overwhelm short sellers and force them to close their short positions, leading to a spike in the stock price. The strategy appears to be working as both stocks are up by large sums since the buying began several months ago. Even though the business prospects have not improved enough to justify the price increases. At the onset of the COVID-19 pandemic, GameStop and AMC each had to close all of their locations to in-person customers. Fortunately for GameStop, it has a thriving e-commerce business that offsets some of the losses from the lack of in-person customers. AMC has no such fortune. All its locations had to close, and without any offsetting business, the theater chain started bleeding cash. However, The number of people getting infected, hospitalized, and dying from COVID-19 is decreasing worldwide. And with over 90 million doses of vaccine administered to people in the US, states are starting to relax restrictions on businesses. In fact, New York announced that it would allow movie theaters to reopen with limited capacity. California is going to allow theme parks and some sports stadiums to reopen. And Texas announced that it is removing all restrictions on businesses as of March 6th. GameStop and AMC suffered losses in revenue and earnings as the coronavirus ravaged businesses and livelihoods. The video game retailer and movie theater chain can now share cautious optimism that their businesses can return to some form of normalcy as the world bounces back from the devastating virus. Still, the pandemic will leave a lasting impact on both. Studios like Disney exclusively releasing new blockbuster films on a streaming platform, which could reduce moviegoing. And video game makers are shifting sales of games to digital channels, which reduces the need to visit a brick-and-mortar retailer like GameStop. If you are looking to increase your wealth in the long term, there are better stocks than GameStop or AMC. But to get you the price prediction and short gamma squeeze. A squeeze is prone to happen when so many fluctuations have happened. In this scenario, investors may find themselves buying or selling shares of stock outside their normal trading pattern in order to minimize losses. But, well, a squeeze can happen when a stock price unexpectedly comes under pressure. Investors who own the stock may feel squeezed by rapidly changing prices, and as a result, they change their positions in the stock. A short squeeze is a specific type of stock squeeze. With a short squeeze, an increase in stock prices can force people who shorted the stock to buy back their shares. Shorting means investors are betting that the price of a stock will go down rather than have it increase. A short squeeze can end up driving stock prices up, sometimes significantly. Though this upward shift in pricing may not be sustainable for the long term. A gamma squeeze can happen when there's widespread buying activity of short-dated call options for a particular stock. This can effectively create an upward spiral in which call buying triggers higher stock prices, which results in more call buying and even higher stock prices. There seems little doubt now that the top of the January surge was the result of a successful route of several major short sellers who had become complacent, it would seem, with their thesis and taken on too much risk. At the beginning of the year, the short interest in GME, that is, the percentage of the company's stock that has been sold short, was at least 68 million shares. The entire public float, that is, the shares freely trading in the market, excluding shares held by insiders, comprises 45 million shares. A short interest in excess of the float is not impossible, but it is highly unusual and unstable, as events showed. Shares sold short all have to be bought back at some point, unless the company goes completely bankrupt. So one way to view this was as an enormous reservoir of pent-up demand, a coiled spring, which, if somehow triggered, could propel the stock sharply upwards, inflicting huge losses on the short sellers. The basic idea can be stated in simple terms. It involves the use of options, specifically call options, that is, options to buy shares in the future at a defined price, called the strike price, to drive up the price of the shares. It works because when a trader buys a call option, it creates a risk for the counterparty who sold that option. Without further measures, if the shares rise above the strike price, the option seller will have to acquire those shares in the open market at a loss to fulfill the contract. There are many ways to hedge the risk. The conclusion, though, often requires someone to buy a share of the underlying stock. The call is converted at some point into a covered call. The market maker has sold you an option that goes up in value as the stock goes up. The more the stock goes up, the more the market maker owes you. It hedges this by buying something else that goes up in value as the stock goes up, specifically the stock itself. The long simmering processes of detaching investment decisions from traditional price and value concepts, fostered by passive index tracking and high-frequency trading, among other trends, had looked like a slow, anesthetic drift away from rational pricing. The game stonk route accomplished in 3 hours what it took the engineers of the legendary Volkswagen short squeeze 3 long years to execute. And now the swarm was showing they can do it again, even without the short squeeze. Many things are swept away in this storm: rational price discovery, market efficiency, supply-demand equilibrium. We'll have to get used to a new sort of market regime and hope for the best. Well, that's all for today, folks. Hope this video helped and the confusion surrounding the bubbling topic in the stock market has been cleared out. If you found this video helpful, make sure to give it a thumbs up. And for more content like this, subscribe to our channel. See you next time. Goodbye.